In this session, we will be dealing with the forward markets and contracts, especially the computational elements of the forward markets. So, from that dimension, we are looking at a few types of instruments. One being, how do I look at the forwards on non-dividend paying stocks. We would also look at equity forwards, means the forwards on equity contracts, probably where dividend plays a role, and also we will look at the contracts on equity indexes. Similarly, we would look out for fixed income forwards, forwards on fixed income securities, again where coupon is involved, and similarly we would look at the forward rate agreements, FRAs. We would also focus on the currency forwards, the forward rates or forward agreements on exchange rates. So these are the 5 major categories of forward contracts we will look at, and finally we would also be focusing on what is the counterparty risk that is involved in the forward contracts. So with that as the base, we get started into it. We'll take up some numerical examples wherever possible to get into this pricing aspect. So whenever we talk about any of these contracts, we are focusing on 2 dimensions. One is the price of the forward contract, which is otherwise called as no arbitrage price. Right, we are talking about the price of the forward contract, and 2, we will talk about the value. Any forward contract, it could be on equity, it could be on a bond, or it could be on an FRA, whatever it is, anything we are trying to compute, any forward contract we are planning to look at, 1, we have a price to it, 2, we have a value. Price is determined at the time of entry into the contract, right, which is a kind of a mutually agreed upon price between both the parties, or probably one party is willing to pay this to get the delivery from the other party. All these are the meanings of the price, which is decided on the day of entry into the contract. So in a regular forward contract where there are no dividends or no cash flows intermediately, we price those kind of forwards as the S0, which is the current market price, into 1 plus R to the power T, where R is we treat as the risk-free rate of return. So any case of no arbitrage forward pricing, we take the spot price into 1 plus R risk-free rate of return to the power whatever is the time to maturity. This is the typical simpler form of the forward contract price. And when we talk about the value, we can talk about the value either at the initiation of the contract or somewhere. So let's say if I am having a 90-day forward contract, right, what is the price as on this day is what is the pricing. And when I am talking about the value, I can decide the value of the contract either here or probably somewhere after the contract got initiated but before the expiry of the contract, or on the maturity. Remember one thing, wherever the question is about value, we will find out the value as the spot price, which means on that day whatever is the price, minus the present value of the forward price. Forward price is the price that has been contracted by both the parties on the initiation day of the contract, right? In most of the cases we will find that at initiation the value of the contract is 0 to both the parties, because no party want to make any additional payment on day 0 to the other party, except in case of off market forwards. Probably off market forward is something which I would be looking as one party having an advantage over the other party on the day of entry into the contract itself, which means on the day of entry into the contract this equation does not hold true. Probably F is either more than this or F is less than this. So that is the scenario where we call them as off market, because the forward price is not reflecting the no arbitrage price based on a risk-free rate of return. So those kind of forwards are called off market forwards, where one party has an advantage on the day of entry of the contract itself compared to the other party. And in those kind of contracts we will see that one party makes a payment to the other party, whereas in all other cases at the initiation we find that the value of the contract is 0, which is nothing but the spot price minus the present value of the forward price. But any time down the lane we talk about the value of the forward as the spot price on that particular day minus the present value of the forward price which has been contracted. So this kind of a definition is what we call as the value to the long position, and in case I need to find out the value to the short position, I take the negative of that, which will give me the value to the short position. Just let's take a couple of numericals to get a clarity on this aspect. Compute a no arbitrage 120-day forward contract price on a non-dividend paying stock. So this kind of formula S naught into 1 plus R to the power T is applicable only when it is a very simple underlying security where no dividends or cash, any other intermediate cash flows are involved. So no arbitrage 120-day forward contract, which means the expiry date of this forward contract is after 120 days, currently selling at 300 bucks. So the spot price is 300 and the risk free rate is 8%. So what do I get? The no arbitrage forward contract price is nothing but 300 into 1.08 to the power T, 120 days, probably because this 8% is annual. I will take this as to the power 120 by 365. So this is how we get the no arbitrage forward price on this kind of a security. So going back into the spreadsheet to compute the same, I will get the forward price as 300 into 1.08 to the power 120 by 365, which will come out as 307.69, right? I am getting it as 307.69. So that is the no arbitrage forward price. 307.69 is the no arbitrage forward price in this kind of a deal. Now, how am I looking at the value? If the spot price of the stock after 1 month, so basically on this day we have entered into the forward contract where the forward will be expiring 120 days from today. Now what are we saying? Spot price of the stock after 1 month. So we have moved 1 month into the contract. On this day the spot price is 305.